You talk about Gresham's law.
Oh, yeah. Most people know what that is, but we'll go over it again.
Define what it is quickly, and then just how does it relate to Bitcoin?
Yeah, so Gresham's law, Sir Thomas Gresham was in the 1500s. He was an advisor to Queen Elizabeth I in England, and he penned a law that basically said that good money drives out bad, bad money drives out good. Mm-hmm. So what that means is if there are two forms of money being used, people will spend the one that's depreciating in value and hoard the one that's holding its value.
That's right. Yeah.
And so in today's world, what that means is you spend fiat, and we know fiat is debasing in value by 8% a year, which is the underlying long-term trend in the growth of M2. I mean, that's just a fact. It's happened. On the other hand, you take gold, which used to be the only form of sound money, and it's only being debased at 1.7% a year. Right. And so people would hoard gold, and they would spend fiat, save in gold and spend their money in fiat. And that's an example of Gresham's law. Yeah. Bitcoin, which is only debasing at 0.8% a year, and every 4 years that'll get cut in half, right, is now even sounder than gold. I mean, the stock to flow is much higher than gold. So, basically people are hoarding Bitcoin, knowing that it will hold its value, but to the degree that they need to make expenditures, they'll convert a piece of Bitcoin into fiat and use fiat to pay, because and maybe they'll pay with lightning rails and all that kind of stuff.
Or they'll try to pay it from fiat reserves first, or current income.
Exactly. I mean,
before they'd sell the good money.
You hang on to and save the money that you know that has the best chance of holding its value over time and space.
Right.
And Bitcoin, there's no better money for that than Bitcoin.
Right. And that's back to kind of the mathematics driving the monetization of Bitcoin.
We all know what the rules are.
Yes.
Yeah. And they can't fuck with it.
Yeah, and this is where it's serving the individual self-interest. Like, of course you accumulate the thing that's being debased the least, because that maximizes the preservation of your purchasing power across time. And of course you spend the thing that's getting debased the fastest, because that's depleting your purchasing power.
Exactly.
Why not sell it?
Why not?
Yeah.
Yeah. And by the way, I mean, look, if you don't have any savings, if you are just literally living hand to mouth, this debasement isn't really such a big issue for you.
Sure. But everyone, I mean, if you don't have any, you're basically either increasing your savings or decreasing your savings every month, week, whatever period you want to look at it. And so therefore everyone should have at least some savings, even if you're just increasing $1 a month or whatever.
Of course.
You better not be going the other direction, because if you do that, you're going bankrupt. Yes, exactly. Yeah. So this is applicable to everyone, basically.
It is applicable to everybody. Yeah.
Obviously, more applicable to people that have larger savings.
Correct.
Because they have more to lose, but still applies to everyone.
Correct. Yeah.
So you have this interesting kind of perspective that you're calling for a ban on financial derivatives, which have been called. Weapons
of mass destruction. Yeah, financial weapons of mass destruction. That's what Warren Buffett, one of the smart things he said. He's also said some stupid stuff about Bitcoin. He said Bitcoin is rat poison. There's a footnote in the book, and I said, and you're the rat.
Yeah, exactly.
So here's the thing. Here's how I see it. The central banks can make, as you say, they can make the exception. They've got the printer. They can print whatever they want. Let's talk poker, for example, as a good metaphor. If you're at a poker table and a bunch of us have, $1,000, and you come in and you have $1 million, and we're paying, unlimited stakes poker, you can say whatever hand you want. You can bet $1 million, and none of us can call you because we don't have it. Right. You win.
Yeah.
Okay. That's what the derivative game is, writ large.
Right.
If you can bluff the market,
lean on your opponents.
Lean on your opponents. If you have more purchasing power through a derivative contract than the entire size of the market, you can distort the market.
Yeah.
And if you've got the printing press behind that derivative action to print and cover it, the market can't call you, so to speak.
Right.
And so this is what happened. This is how they manipulated the gold price down from 1900 in 2011 to 1,000 in 2015. It was so beautifully done, so coordinated by the BIS and the central banks. It was unbelievable. It was like a military operation. I mean, Goldman Sachs came out and announced out loud, to all their clients, gold is overvalued. We highly recommend you short it. Okay, the BIS made some statements, the Fed made some statements, et cetera, et cetera. And this is a period where it just run from $250 an ounce in 2000 up to $1,900 an ounce in 2011. So you can imagine some central bank, and the money printing started in 2008. So there were some central bankers who were, they had tight sphincters. They're saying, holy shit, we're losing control of the gold price. This is not good. Okay. So what did they do? Goldman makes the announcements. They get all their clients short it. Okay. They get the central bank's coordinate. And then within the space of like a month, they just literally bombed the shit out of it. It was down $150 one day. I was on vacation when it happened. Just talked about in the book. And the volumes that were going through, there's no way they were rational sellers.
Right.
No seller would, nobody had that kind of volume to sell except for the central banks. And so they literally just attacked the gold price,
right,
and took it from $1,900 down to $1,000, you know, to save their system.
Yeah.
And they could do that because they could use the derivatives. I mean, they weren't selling gold that they had. They were selling paper gold,
right,
which is part of what's blowing up right now. I mean, the gold game is very much like a big game of musical chairs. There are X number of physical ounces in the world today. Right. Okay, they just exist. They're hard.
Yeah.
I mean, you can touch them and feel them, right?
Yeah.
Okay. We believe, and there's a lot of evidence that shows, based on looking at the data, that there are between 100 and 300 claims on every single
200x.
Yeah, on every one. Let's say it's 100.
Yeah.
So for every one of those ounces, there are 100 paper claims. So there are 100 people who hold a piece of paper that says, I own gold.
Right.
But they don't.
Only one of them does.
Only one of them does.
Yeah.
And if they all ask for it at the same time, price of gold would go bananas.
Right.
Okay? Yeah. It's the paper gold market. It's the derivative-based paper gold market that has allowed that to occur.
This perfectly mirrors fractional reserve banking.
Exactly. Right? Yeah. And it's all laid out in the book. I mean, so this happened. It started with Clinton, and Summers and Barsky wrote an article or a paper, which you can find on the web, called Gibson's Paradox. So Clinton wanted to get reelected. It's in the book, on his second term. And they realized that in order to do that, they needed to have economic growth. They realized the easiest way to get economic growth was to have inflation, right? Because you get top-line growth with inflation. They also realized that if they had inflation, remember Carville, who was his advisor at the time, said, Clinton said, you mean to tell me that I'm not going to get reelected because a bunch of fucking bond traders, the bond vigilantes, are going to blow up the bond market? And Carville said to him, yeah, when I come back in my next life, I want to come back as the bond market because you can intimidate anybody, okay? Well, Summers, who was Treasury Secretary, and Rubin, Rubin was Treasury Secretary, Summers was, I think, Chief Counsel of Economic Advice. They devised a mechanism. They said, don't worry about it, sir. We'll print the money and we'll attack the gold price at the same time. And if we can hold the gold price down, people won't think there's inflation. Yeah. So you're good. You're good to go, right? Crazy. And that's what happened.
Okay, very important that people understand that. I think, especially gold bucks, right? Like this is how that's played out. There's been a lot.
And that's why gold hasn't worked, by the way.
Yeah, the Gold Antitrust
Action Committee. Get it? Yeah, those guys are great.
They're great because they've
Bill Murphy, Chris Powell. They go to their site. It's all documented.
Yeah, they're documented, and this is not just in the U.S. They've done it in London, everywhere, and all over the place.
All over the place. Yeah,
coordinated suppression of the gold price.
Yes.
Really to uphold the integrity of fiat currency, right? Because if people had a better alternative, well, they would sell all their fiat and buy gold.
Correct.
So they need to squash the price of gold to prevent that run from happening.
Right.
How do you, let's say, critics of Bitcoin that would say, oh, they're just going to do the same thing to Bitcoin. How would you?
That's a really great question. And I mean, George Gammon made a good point that there'll be paper Bitcoin in the future, and there could be. If you look at it today, there's not a lot of paper Bitcoin. You can see the number of derivatives, futures, options, et cetera, contracts out there. Compared to the total amount out there, the total amount on exchange, the total trading, they haven't done it. I mean, recall that they've had since the 70s to perfect this gold scheme, okay? And gold is a slightly different beast than Bitcoin. Gold has never had a year where it's gone up 5x, okay? Bitcoin has, okay? So suppressing gold and then waiting for it to come back down so you can cover your shorts without taking a loss or having to print a lot of paper to cover the loss has been an easier game than with Bitcoin. Bitcoin is, it's a wilder animal from a price point of view, so they can't necessarily get their arms around it quite as quickly. But to be fair, it is somewhat of a risk. I mean, I think that a couple of things argue against it. One is the whole notion of proof of reserves, which I think River is doing a very good job of, showing. I mean, basically, we get into trouble when people start claiming they have Bitcoin and they don't have Bitcoin. Right. Yeah. So, one of the things that I think has happened is GLD, which is the biggest gold ETF. I don't think they have all the gold they say they have. Okay. So people have put money into GLD. That money has not gone to buy real physical ounces. It's just money that's there. They have a fraction of all the gold they say they have, but not all of it, in my opinion. And so if that kind of thing were to start to happen in Bitcoin, if BlackRock were to start to not buy, I mean, if the auditors were in on it with BlackRock and BlackRock were taking money in for the Bitcoin ETF, but not actually buying all the Bitcoin they claim to have, that would become problematic. And you know, I don't think that's beyond the realm of possibility, but you know, you'd have to get the auditors in on it. And I think there's, you know, because of Bitcoin's, your ability to do the on-chain analytics, that's another piece of this whole thing. I mean, you had double entry accounting. I mean, Bitcoin, you've kind of got triple entry accounting.
Right.
You know, you've got independent people can see where all the transactions are. So I think it's more manipulation proof than gold in a large way. Easier to see, easier to verify, easier to move. Yeah. But I don't think it's completely manipulation proof. And I think it's something we always have to watch. And that's why in the book, you know, there's a chapter in the book called Policy Response, where I basically talk about, okay, we're in a friggin' mess. How do we get out of it? Okay. And I say, you know, we got to do this, this, and this. And then at the end of it, I say, we got to ban derivatives. And that's why. Because we don't want Bitcoin to be corrupted in the same way that gold was corrupted. Got it.
Yeah. So there's definitely new advantages Bitcoin has in this regard. And that you can have cryptographic proof of reserves, right? And it's a very lightweight, low cost informational audit, right? You can basically prove that you have what you say you have.
Correct.
That if you try to do that with gold, it's a whole different thing, right? You got to get people involved and then documenting.
Well, the perfect example, I'm sure you've thought about it, is, you know, we say we have 261.5 million ounces of gold in Fort Knox and in New York at the West Point and in the Denver vault. I mean, San Francisco vault too. And that hasn't been audited since 53.
Yeah.
I mean,
there's rumors that it's all gone.
Right. I mean, occasionally, you know, Ron Paul told me he thinks it's all gone. I mean, occasionally somebody will go in there and look at a few rooms and say, oh, yeah, there's some gold here. But is it all there?
Right.
I don't know. I mean, right?
Yeah. So there's that. That's a very major advantage for Bitcoin.
Right.
In terms of not being as vulnerable to these price suppression schemes.
Right.
There's also the portability dimension, right? Like you can settle with Bitcoin, like you said, in 10 minutes, in an hour, basically with finality. If there's ever even a sniff of malfeasance, you can withdraw, move, like go to a more trusted counterparty, go into self-custody, like
all of it.
The hyper portability of Bitcoin makes it more resistant to these schemes. Where gold is like, well, it's in this place.
As you're seeing right now, there are people who have gold in the LBMA vaults that are asking to get it out, and they're being told they can't have it, or you know,
wait 6 weeks,
wait 6 to 8 weeks, and maybe we'll get it for you, you know, whatever. I mean, this, you know. I don't know. We've seen this before, and I don't want to get way ahead of myself. I don't want to get too far out over my skis. This could all calm down. Deliveries could return to normal. Everything could be fine. Or this could become, you know, this is the smoke, and there turns out there's a real fire, and the paper gold market is in trouble. I mean, I think that's certainly within the realm of possibility.
Well, at 100 to 1 on the low side, the trouble's coming at some point.
It feels to me that way.
Just a matter of when.
But it hasn't happened yet. I mean, this is. All of these events, I mean, they're what I call kind of quote unquote critical state events. Yeah. Avalanches are critical state events, right? You know, a bunch of snow sitting there.
Yeah. Right.
One snowflake falls.
The hair that broke the camel's back.
Exactly. They're all critical state events. Yeah. And when they happen, I mean, and that's why I make this point in the book. I mean, it's kind of like there isn't going to be a do-over here. You know what I mean? You're either going to, I mean, if we really do have a big monetary event, a big print, a big reset. Yeah. You know, it's a one. You know, you're not going to say, "Oh, gosh, I'm sorry, I fucked that up." Yeah. You know, I want to go back and do it over again. It's going to be like, no
do-overs.
There's no do-over. You know, Bitcoin is now it's now $1 million bid. Gold is 10,000 bid. Do you want some or not?
Yeah.
Right. Yeah. I mean, pick one.
And you're going to remember where you were when that happened, right?
I think we will.
Yeah.
It'll be like 71.
Thanks for watching. If you enjoyed this episode, click here to find more just like it, and here to find our most recent episode. Also, make sure to like this video to help shine light on the corruption of money, and be sure to subscribe to this channel to stay connected.